Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Lucia Gugliuzzi, mortgage broker in Vaughan-Woodbridge, Ontario.
If you're self-employed in Vaughan or Woodbridge and your accountant has done a great job keeping your taxable income low, what happens when the bank looks at that same number and tells you it's not enough to buy a home?
That's the trap, right? You've been smart about your taxes, and the mortgage system penalizes you for it.
And it happens constantly in this market. Someone came to Lucia Gugliuzzi recently, a contractor, solid business, years of history, good revenues, and the bank's calculator just didn't reflect any of it.
Because the bank is reading the net income on the notice of assessment, not what the business actually generates.
And that gap, between what you earn and what the lender sees, is exactly the problem that Lucia Gugliuzzi's work is built around solving.
Let's start with why the standard process fails here, because it's not personal and it's not random. It's structural.
Right. The major chartered banks use net income from your tax returns as the baseline for what you can borrow. That's the system.
And for a salaried employee, that works fine. Your T4 says what you made, the bank uses that number, done.
But self-employed borrowers, whether they're incorporated, sole proprietors, contractors, they reduce taxable income through legitimate business deductions. That's smart tax planning.
The problem is that the mortgage system and the tax system are measuring income completely differently. They're not designed to talk to each other.
So a business owner who is genuinely financially stable, genuinely capable of carrying a mortgage, ends up with a notice of assessment that makes them look like they can't qualify.
And that's where Lucia Gugliuzzi's approach, what she calls mortgage strategy solutions for self-employed borrowers, becomes a distinct discipline, not just a variation on standard mortgage advice.
Because the knowledge required here is specific. Which lenders use gross revenue? Which ones accept add-backs for certain business expenses? Which programs allow a stated income approach?
Let's talk about stated income programs, because there's a lot of confusion about what they actually are.
They're not a workaround. They exist precisely because the tax system and the mortgage system measure income differently. They're a recognized lending category.
A stated income program lets a self-employed borrower qualify based on a declared income figure that's supported by the business profile, rather than the net income on the tax return.
But the income you state has to be reasonable. Lenders look at the type of business, the industry, how long it's been operating, the gross revenues. They're assessing whether the declared income is plausible.
A general contractor with 3 years of history and strong gross revenues can reasonably state an income that reflects what the business actually generates, not just what's left after deductions.
These programs are most commonly available through B lenders and some credit unions. And one thing that doesn't change regardless of the program, the stress test still applies.
That's important. Under federal OSFI rules, you qualify at the greater of the contract rate plus 2%, or the published minimum qualifying rate. Stated income doesn't exempt you from that.
So knowing that in advance helps set realistic expectations about purchase price before you start looking at properties. That's part of what Lucia Gugliuzzi builds into the conversation from the start.
And there's a practical step she emphasizes that a lot of borrowers miss: talking to your accountant before you apply, not after.
If you know a mortgage application is coming in the next 12 to 24 months, there may be adjustments to how business income is reported that improve your qualifying position without compromising your tax strategy.
That conversation between your accountant and your mortgage broker is one of the most valuable things a self-employed borrower can do. Lucia Gugliuzzi is explicit about that.
Now let's talk about the documentation side, because this is where a lot of files either succeed or fall apart before they even reach underwriting.
The standard package for a self-employed mortgage is 2 years of personal tax returns with all schedules, 2 years of notices of assessment, business financial statements prepared by an accountant, not internally generated, and evidence of business registration.
For incorporated borrowers, 2 years of corporate T2 returns are also typically required. That's the baseline.
But beyond the standard package, supporting documents can strengthen a file significantly. Bank statements showing consistent business deposits over 12 months tell a story that tax returns sometimes can't.
Contracts or letters of engagement from clients demonstrate ongoing revenue. And a letter from your accountant explaining the income normalization, The add-backs can make a real difference in how an underwriter reads the file.
Add-backs are worth understanding. When a lender allows them, they're reversing certain deductions from your net income, depreciation, amortization of business assets, certain one-time expenses, to arrive at a higher qualifying income.
Not all lenders apply add-backs the same way, and not all lenders allow them at all. That's one reason lender selection matters as much as documentation preparation.
And Lucia Gugliuzzi works across all three lender categories: A lenders, B lenders, and private lenders. Which means the file goes to the right place, not just the most familiar one.
Let's map those categories quickly, because self-employed borrowers in Vaughan-Woodbridge need to understand what each one means for them.
A lenders are the major chartered banks and federally regulated institutions. Best terms, strictest documentation requirements. If the net income on paper supports it, that's always the first option to explore.
B lenders fill the gap for borrowers who don't meet A lender criteria but have a fundamentally sound financial position. They accept stated income, work with lower credit scores, apply more flexible debt service calculations.
The trade-off is a higher rate and typically lender fees. But the goal with AB lender approval is always to use it as a bridge, strengthen the file, then refinance to an A- lender at renewal.
And private lenders are the most flexible and the most expensive. Appropriate for short-term situations, where speed matters, or where the profile doesn't yet meet B lender criteria.
Here's the thing about Vaughan-Woodbridge specifically. Property values in this market mean that many purchases fall above the insured mortgage threshold. Which means insured stated income programs aren't available for those purchases.
So uninsured alternative mortgage financing options become the primary path for a lot of buyers in this area. That's a layer of complexity that's specific to this market.
And it's exactly why having Lucia Gugliuzzi, a mortgage broker in Vaughan-Woodbridge who specializes in alternative mortgage financing, matters so much for these files.
Now I want to get into what I think is the most urgent issue for borrowers who are already in alternative financing: prepayment penalties.
This is where real frustration lives. A borrower takes a one-year closed private mortgage, fully intending to move to a conventional lender at renewal. 12 months later, the income documentation is stronger, the credit profile has improved.
But a lender exception takes an additional 60 days to process, and the private mortgage term ends before the new approval is finalized. The penalty for that 60-day overlap can be thousands of dollars.
And that outcome is avoidable. But only if the prepayment structure was discussed before signing, not after.
An open private mortgage costs more in rate but allows you to exit without penalty the moment your conventional approval comes through. A closed mortgage is less expensive to carry but locks you in.
The right choice depends on how confident you are in the timeline for improving your qualifying profile. And that's a conversation Lucia Gugliuzzi has with every client before they sign anything.
Because alternative mortgage financing is a tool, not a trap, but only when it's structured with a clear exit plan from the beginning.
The exit strategy isn't something you think about after you've signed. It's defined before the ink dries. That's the core of what Lucia Gugliuzzi means by mortgage strategy solutions.
A structured exit starts with an honest assessment of what's keeping you out of conventional financing right now. Is it the income documentation? A credit score that needs deliberate management? A gap in self-employment history that closes with time?
Each of those has a specific timeline and a specific set of actions. And the alternative mortgage term should be chosen to align with that timeline.
Credit is worth spending a moment on, because it's one of the most actionable variables in the equation for self-employed borrowers.
For borrowers whose credit has been affected by business cash flow fluctuations, and that's more common than most people admit, the path forward is specific and measurable.
Paying down revolving balances is the single most impactful short-term action. Keeping utilization below 30% on each revolving account has a meaningful effect on the score over time.
And for borrowers with more complex credit history, a past consumer proposal, collections, a period of missed payments during a difficult business cycle, there are lenders who specialize in exactly those situations.
The terms are different, and the path to conventional financing takes longer. But it is a path. The important thing is understanding where you're starting from and what the realistic timeline looks like.
That honesty is something Lucia Gugliuzzi builds into every client conversation from the beginning. Not optimistic, honest, and then actionable.
So let's bring this back to the borrower who came to Lucia Gugliuzzi, the contractor whose bank application didn't reflect what the business actually generates.
With the right documentation strategy, the right lender category, and a stated income approach that reflects the actual business profile, that borrower has a path. A real one.
The file gets organized properly. The accountant is looped in. The income is presented in a way the right lender can work with. And the exit strategy is defined before anything is signed.
The client closes. And they close knowing exactly what the next step looks like. What needs to happen over the next 12 to 24 months to move toward the most favorable financing available.
That's the outcome. Not just an approval, but a plan. Because the approval is only the beginning of the strategy.
If you're self-employed in Vaughan-Woodbridge and you've been told the numbers don't work, get a second opinion from someone who works these files every day.
Lucia Gugliuzzi is a mortgage broker in Vaughan-Woodbridge, Ontario, specializing in mortgage strategy solutions for self-employed borrowers.